Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Please don't forget to like and subscribe. Click the bell so that you get a notification of when we release a new video. I'm sitting today with Michael Porter. Welcome back, Michael.
Hello, Robin.
Michael, we've just done a series of presentations, our Insight series around the country, and there was one overriding question from every group of participants, and that was really about this Silicone Valley Bank and the New York Bank and then Credit Suisse. Are we facing another global financial crisis?
Good question, Robin. So this is quite a complicated topic, so let me try and get through it quite quickly. Basically, what's happened with Silicone Valley Bank, SVB, let's just call it for short, is that they lend mainly to the tech industry, and they only had about 3,000 clients, which is actually very small for a bank. All these tech companies raised a lot of money over the last couple of years, and deposits flooded into the banking system because there was all this cheap money around, all the liquidity that the Federal Reserve put out in QE and all those things, and all this money flooded into banks, and banks they were just swimming in deposits, so they didn't know what to do with them. So Silicone Valley Bank had a very small amount kept in cash, and they invested the balance in government bonds to try and earn a better return on all that cash sitting in the bank. The problem is that that wasn't a problem until interest rates started to rise, and interest rates started to rise very sharply, obviously, last year. Now the problem is that funding for the tech industry is dried up, so the tech companies themselves actually want to draw down on some of their deposits to fund salaries and operations and things like that. They started to take their money out, and SVB couldn't meet all those deposits. So they had to start selling all their bond holdings. The problem is that they were selling these at a loss now because interest rates have weakened, and they realized that they had a big loss. They didn't have enough, not that they didn't have enough capital, but they needed to raise extra capital to fund the liquidity. And when they went to raise extra capital, the market got panicky. And I was reading in one thing this morning, the thing when you're having a crisis or conflict in a bank is to panic first.
Yes.
And all SVB's clients panicked, pulled their money out, and obviously they couldn't meet the deposits. There's a run on the bank, the typical thing that happens. And then the same thing happened with Signature Bank in New York over the last weekend. Basically, they had actually taken in crypto as deposits. Again, very small niche bank, quite focused on real estate and one or two other sort of sectors of the economy. And again, just they couldn't really meet the deposits because of the way they'd invested all the money that had come in. And I think, but really in both cases, Robin, it's really a failure of internal risk management. SVB wasn't a bad bank, but they didn't hedge their interest rate risk. They should have hedged their interest rate risk over the whole period. They maybe, like other people, thought that inflation was transitory, interest rates weren't going to go up. That was a bad miscalculation. So it's really about internal controls more than actually a systemic issue in the whole banking sector. But obviously, when you have one or two banks that go under, everybody starts to question every other bank. And there is an issue with another bank in America at the moment, First Republic Bank, where all the big banks had to step in last night and put extra deposits in. So everybody's just a little bit jittery. The Federal Reserve has come out and guaranteed deposits that, no one has to panic at SVB and they're going to lose their money. Everything will be guaranteed, and hopefully that just brings some law and order into the system. Well, not law and order, just some calm into the system and lets everybody calm down. Credit Suisse is a completely different thing. Credit Suisse has been on the slippery slope for about 2 years. They've had a number of scandals at Credit Suisse. So Swiss banking, the bastion, the safest place in the world. There's nothing safer than Swiss banking, right? So we thought. Yeah. Credit Suisse has just been rocked by scandal after scandal after scandal. They were involved in that Mozambique bond scandal where the Mozambique government was corrupt. They've had a number of scandals. They've had 2 CEOs resign in the last 2 years. Just a lot of scandals, and then basically over the last 18 months to 2 years, they've just been making losses, and that's just clients losing faith in the bank, not doing their job properly. So Credit Suisse, from an operational point of view, has been getting weaker and weaker and weaker, and they've reported, I think, 5 losses in the last 8 quarters. UBS, on the other hand, is completely different. So Credit Suisse, just as a bank, hasn't been performing very well. Obviously, now you have these concerns, and when you have these concerns, I suppose everybody gets jittery. Credit Suisse has been on the ropes for a little bit. People started to get jittery. Credit Suisse's actual capital ratios and everything are absolutely 100%. They've got no issue paying out deposits. But I think there's just a broader concern in Credit Suisse that it's just a weak bank that isn't actually making money.
So Michael, obviously that jump from America to Europe, I'm guessing that there's an awful lot of our clients who are making the jump from America, Europe to South Africa. So what's the story with the South African banks?
Yeah, so that's a good question, Robin. So in intuition that went out last week, we basically got a table in there basically showing how South African banks are capitalized. So after the financial crisis, a new set of regulations came into play called Basel III, which basically stipulates how much capital banks have to have. Basel requires that you have to have a core tier 1 level of capital of 6%, and then a total capital of 8%. Okay. Our Reserve Bank has taken that one step further and said, Basel says 6%. Because we're an emerging market, because we're South Africa, because we've got all these other issues, we require our banks to have at least 8.5% core tier 1 capital. Yes. Our banks, in terms of their own internal risk management policies and board policies, all the banks have a policy that core tier 1 capital will be between 11 and 12.5%. So now you can see Basel is 6. Our banks, from their own management point of view, are sitting at roughly 12% or 13%, double the regulatory essentially minimum. And then if you add the other capital on top of that, most of our banks are sitting at sort of 16, 17%. So our banks are very well capitalized. And in terms of liquidity and solvency ratios, they're well above the Basel minimums as well. So listen, our banks are, I think, a completely different kettle of fish to American banks, Robin. In America, we've discussed this. There's thousands of banks. There's lots of little regional banks. We have 5 big banks across the country, and our banks are diversified. They don't focus on one sector. They have retail clients like you or I. They have corporate customers. They have small businesses. They have large businesses. They have businesses across Africa. They're actually very, very well diversified. They're not reliant on one small pool of customers or something to function. So the chances of this spreading over to South African banks from a bank failure point of view, I think, is near zero, quite honestly. And I hope that doesn't come back to bite me, but I really do feel that it's near zero. From the point of view that share prices can weaken because of global sentiment, well, I mean, that's obviously what happens when you're part of a global capital market. So share prices can come off, and which is really frustrating because banks have really released good results of late. But we would then see that as an opportunity to invest in the banks as opposed to running away from them.
Yes, at a very attractive dividend yield with some nice dividend growth coming in the future.
Exactly.
Awesome. Michael, thank you for shining light on that. Thank you once again for joining us. Don't forget to like and subscribe, and we'll see you next time. Bye-bye.
Bye.